Welcome back, traders. It's good to be back for Friday, March 8th. It's time for a general market update. Just our typical disclaimer, I'm an individual growth stock investor, not affiliated with MarketSmith or IBD. So this is what we're going to cover. We're going to get into the indices, the market internals. There's a lot of interesting things going on. Then we're going to look at the leadership and the leaders. And then we're going to look at following the leader. And then we'll summarize. So let's get into these indices and some of the internals. So it's quite an interesting situation because it can probably make a bullish case as well as a bearish case. This is the S&P 500. We've been grinding our way to new highs and new lows on our bottom panel here have shown fairly strong on the S&P and New York Stock Exchange. We're going to look at the NASDAQ in a moment, which is a different picture. So we had a reversal today, not unexpected. What's interesting is if you look at the percentage of S&P stocks that are over the 50-day moving average here, you can see that it's improving. Since middle of February to where we are today, it's gradually gone from about 55% to 75%. So that's really good improvement, showing that in the S&P, in the broad market, things are improving. And the sectors that are really doing well in the S&P are the industrials. This is the XLI on a weekly chart. You can see that it's at new highs, up 8 weeks in a row. Right below that, I've got the home builders. The home builders are also right at new highs. So that's also encouraging, helping the S&P. And the materials, the XLB ETF, you can see it's near new highs, but it's been up 7 weeks in a row with some pretty good volume. So that, plus you combine some of the tech weightings in the S&P, such as NVIDIA and Apple, you can just understand why the S&P seems pretty strong. Now, you can also look at it from a different point of view and say, let's look at the equal weights. So this is the equal weight S&P RSP. Again, this is a weekly chart, line chart. You can see that it's at new highs. So we don't have some dramatic divergence here. The equal weight version is also at new highs. Now, if we look at the Qs and we look at the equal weight Qs, they also are coming up right up against the old highs, very close. Maybe they're going to back off a little bit. But that's kind of the bullish scenario to say, look, things are still doing well. Some of the weighted indexes, which are broader, are actually showing us some decent breadth. But we also want to turn our head to the NASDAQ. That's the mostly technology, some of the growth stocks that we participate in. So this is the NASDAQ composite. Now, the black line here is the index. The headline is, the NASDAQ continues to make new highs. So on the surface, you see it a lot in the news. Everybody's talking about new highs. But there's a couple things that are really getting concerning. One is, if we look at the new highs, new lows, you can see that as we were having new highs following the index higher, you can notice that the trend has been that the new lows are starting to expand. That's not a good scenario. We don't want to see new lows expanding because it's showing some deterioration in the NASDAQ. In addition to that, if we look at the percentage of NASDAQ stocks that are above the 50-day moving average, you can see that this line is flat. We just looked at the S&P, but this line is flat. The index is moving higher, and we really have not moved off of this 50 level for quite a while. So we're not seeing as much participation in the NASDAQ, and the NASDAQ is being carried really probably by the Qs and NVIDIA, et cetera. So not a good scenario for the NASDAQ. It's cautionary. And then when you zoom in a little bit on the daily action on the NASDAQ, which I've shown in this market surge chart, you can see that we've been getting this cluster of distribution over the last 2 to 3 weeks. There's been a lot of distribution in the market and some stall days. And we're also seeing stall days on some individual stocks. Now, yesterday on the surface looked like a good day. The indexes were up, but really low volume. So that was a clue that things were not right. And then today we got the move up early, and then within an hour or two we reversed hard. So that's really an expectation breaker as the index tried to move into new high ground. So the NASDAQ is not nearly as strong as the S&P. So here's some of the leading ETFs. Let's start with the XLK. The XLK has been getting a little sloppy the last month, but it's moving higher. You can see here, though, we had this stalling day right here where the volume really picked up to quite a large amount of volume, and we didn't really make any price progress. In addition to that, we immediately got hit with distribution, a pretty hard selling day. Then we had a very weak rally and then reversal. So that's showing us that this index certainly looks a little tired. Now, the semiconductors have probably been the strongest area of the market, not only the chips, but also the equipment makers. And I've just taken the SMH here and drawn really an upper channel line. And drawing an upper channel line, you can see we've had an extension through that upper channel line, and then we got the reversal today with NVIDIA reversing hard. So again, this just probably means that these things need to rest. They really have gotten a little bit ahead of themselves. And we've talked about cybersecurity over the last couple of weeks, and I think when we were right around in this area, I mentioned that this could be a head and shoulders forming. It certainly looks like a little head and shoulders is forming. You can see the distribution that we've gotten this week and the software. The software index IGV is also showing kind of a head and shoulders. These peaked out first, and semiconductors have been more resilient. So we're getting some rolling over action in cybersecurity and software. Now let's go into the action of the leading stocks. So this is that same exercise that I've been doing. I did this 2 weeks ago, and you'll notice that here in the red box, these are the names that I've been following for a while. And if you just do the simple squint test, you can see a lot of pink on the chart. Pink means the ratings have deteriorated in those categories. Green means they've improved, and the white means it's pretty much unchanged. But you can see with the squint test, 2/3 of this grouping is really pink, meaning the deterioration in some of the leaders. So that's not good at all. It really is not good. Now, what I also did is I've added to my watch list this group at the bottom. There's a whole bunch of new stocks that I've shown that are really performing. They're doing very well. They're showing good relative strength. They had earnings gap ups. So these are kind of some emerging leaders that are either in uptrends or just had some really good positive action. So they're names that might be added to the list. But again, this picture is not great when the leadership is really, really deteriorating. So this is a comparison chart. Again, you can just see when you look at looking at the SMH, has certainly been the leading ETF. But you can see here's the software and the cybersecurity. They totally have been flattened out and turning down. And you can see here IPOs, though, have actually been strong the past month. That's a good sign to see that some of the new merchandise is still performing well. But the market seems a little tired here, and with the reversal today, that definitely is a cautionary sign. Our IWM here on the bottom, our favorite small cap, is it just could not break out with Powell's comments, et cetera, et cetera. There's just not enough catalyst to get the small caps to really get going. So going a little more granular on some of the sectors and groups, you can see here these two groups that have really performed well over the past couple of weeks of the semiconductors. But we're also seeing some improvement in apparel and shoes, restaurants. The last couple of weeks starting to show some better performance. And you can see the laggards now. You can see cybersecurity has really flattened out. Computer tech services has also underperformed. The black line in the middle here is the NASDAQ. So there's just some emerging new groups, as well as some of the groups that were leading are starting to get tired. So I'll just continue to wrap up this trilogy. That was the earnings wobble from Palo Alto, the earnings stumble from Zscaler, and we wanted to see what was going to happen to CrowdStrike. Was it going to be splat? Well, it wasn't exactly a splat, but there's no doubt that the gap was sold into, institutions sold into that to either take some money off the table or liquidate some positions into that gap up. It was a great earnings report, and even good guidance wasn't enough to really prevent the next day from being sold into. So It hasn't broken down. It's still above its 20-day moving average, but you can see the volatility has picked up dramatically in the stock, which is a little change in character. So need to see this one settle down. Otherwise, if it continues sloppy, showing even more distribution, we'll definitely probably see another test of the 50-day or worse. So it's one to keep an eye on. So the next part of this video is going to be called Follow the Leader. Now, this is taken from a video I did last August 11th, as the market started correcting from the summer rally that peaked in July. And you may want to go back to that GMU update to see the detail around this explanation. I'm going to keep this explanation fairly short, but I'll show you what I'm doing on the chart. This orange line is the NASDAQ composite, and I've shown Cisco Systems in this line here. And I'm showing from 1992 to 2000. And you'll notice that I've drawn these red, blue, green, and blue lines. What I'm trying to do in the chart is to compare when was the peak of the NASDAQ and what was Cisco doing, because Cisco was the leading stock in the 90s. And I also marked the bottom. When the market bottomed, what was Cisco doing? And when the market finally made a new high, how long did it take Cisco to make a new high? So that's the kind of comparison. And I'm going to get to the point of showing you all this and Cisco Systems in the 90s in a second. But the teaching moment is to line these things up, and we'll see what we can learn. And I did this for each of the corrections we had in the 90s. Here's the 96 correction. Here's the 97 correction, the 98 correction when we had a bear market, and eventually we had the bull top. So let's take this a little bit further. So this is looking at the 1996 correction, and it makes my point a little clearer. The NASDAQ peaked out at this point in 96. And you can see that Cisco, which was the leading stock, didn't peak out until about a week later. Then as the market came down, the market bottomed at this point in here. You'll see that as the NASDAQ was bottoming, this is a very long-tailed bar, you can see that Cisco was going to bottom shortly after that. So you can see that Cisco bottomed shortly after that. But what's really is interesting, it took the NASDAQ all this time to grind its way back up before it finally hit a new high. But look at Cisco, Cisco being the big leader. Cisco hit a new high. You can see here's the old peak, hit a new high weeks before the index. That's real strong, tennis ball action. And so I followed this methodology from 94 to 2000 and say, what can we learn? So I'm looking at the peak of the NASDAQ and how did Cisco behave? So you can see here that the Cisco peaked out later than the NASDAQ in almost 4 out of the 5 times. It was basically the last stock to correct when the index was correcting. And then you say, well, what did it do when the NASDAQ was trying to reach a new high? Well, it was one of the first stocks to recover. It was a tennis ball. It recovered and reached a new high earlier than the NASDAQ multiple times. So this is the point I'm showing you this is the character of the big leader. And who is the big leader in this market? Well, it's NVIDIA. So again, this is from August GMU update. This is NVIDIA. Now, NVIDIA had a great run up until last July, and that's when this chart was taken. We said, and I mentioned that this 500 psychological level might pause the stock. And it was sandwiched between the 1 trillion valuation and the 500 level. And it did give us a good read because, NVIDIA needed to base for a number of months. So it was a good clue that the market needed to rest. So where are we today? Here we are today. NVIDIA, I showed this chart last week. It blew through the 2 trillion level around 820. And then we said it might go all the way up to 1,000 before maybe it tires out. And then maybe it needs to base. So we had this explosive rally in the morning and it reversed on volume. So there certainly was some profit taking. And it just might mean that the market, again, we're looking at the big leader, like the Cisco of our time, is going to pause and maybe hopefully bounce around and base out. probably gets support somewhere in the 2 trillion valuation and maybe the top end at 1,000. So it's important to note that that action. Now I took this one step further just to look at Cisco versus NVIDIA, and I found this chart. As you can see the source down below, and it lined up Cisco and NVIDIA, and it showed this kind of comparison. They're acting very similar. Now, I think what's important is, look, new innovations are what lead the big stock market winners. In the 1990s was the birth of the internet, and Cisco was the king of routers and networking to connect things to the internet and to connect computers. And Cisco ended up having an over a 73,000% gain in that decade. Incredible. Now, what's interesting to note is Cisco, when it finally peaked with the market in March of 2000, it was at 80 times earnings. So if we take that analogy further, and there's no predictions here, I'm just showing this really for a factoid of what could be. So in the 2020s, we had this major new innovation, artificial intelligence, and certainly NVIDIA is the king of the high-end chips that support artificial intelligence computing. If we were to use the 2026 estimate for NVIDIA at 80 times earnings, that'd be a price target of about 2,200 for NVIDIA. And you'll notice that that last run that Cisco made, the last real the last push that it had came out of the 1998 correction, and it really pushed to the peak and pushed it to this valuation of 80 times earnings. So there's a case to be made. Maybe we're in this place in the moment. Is the market in somewhere in this place? If it was, there's probably plenty of room to go in this bull market. So just something to note. There's no predictions. It's just kind of something interesting to look at between the two big leaders of their time. So let's wrap up. Where are we with the market and what can we plan ahead? So it's really important. The NASDAQ distribution stalling days is a real negative. It certainly feels like the market's going to come in. It's starting to reverse today. I mentioned new highs and low volume, and then we had these reversals. And with the big leader, NVIDIA, turning in, it could just mean the market needs to base out and correct a little bit. Now, again, we mentioned about, are the key levels holding? Yes, the indexes look pretty good on the surface, but underneath, I show the action of the leaders. The big leaders have either stalled out, they're gapping down, they're getting more volatile. So it's certainly, again, another clue that we probably are going to correct a bit. We're still, a power trend still in place. So that's still a positive on a longer term perspective. New highs and new lows. I think this is cautionary. Don't want to see the new lows increasing like they are again. Even with new highs expanding, we don't want to see the breadth underneath the market with new lows expanding. So that's a negative. Now, the action of leading stocks, we're seeing some stocks stall out. They're rolling over a bit. They've come a long way since early November. So it's probably a situation where a number of these need to base out. And we know bases take at least 5 weeks for a proper flat base, or maybe it's going to be 6, 7, 8, 9 weeks for cup with handles to form or other base patterns. So the market needs time to digest. Now, the good sign is we're starting to see some rotation. We're seeing a new crop of leaders emerging. So we want to keep our thumb right on which groups are starting to perform, because even though technology might be pausing for a bit and basing out, we want to look at the groups that are performing because there may be opportunities. So exposure levels, I've decreased them. I think we should come back down in some of the 35 to 40% range, maybe even lower than that, depending on your gains and what your positions are. You want to make sure you protect the gains you have because you want to manage a drawdown. If the NASDAQ were to correct 5 to 10%, growth stocks are going to come down 2 to 3 times that. So that could be 15 to 30%. So keep that in mind as you're planning. And just experience tells me that we're going to pull in here. I would imagine it could be, somewhere in the 5 to 8% range, but no predictions. It doesn't matter what I say. The market's going to do what it wants to do. But I think that's the assessment. I think it's very cautionary here with the market likely to pull in. So our quote of the week is from Bernard Baruch, the early 1900s speculator. Be more humble as the market goes your way. Those of you that have had some really good gains and are having an outstanding year, do everything you can to protect your gains. Don't get sloppy. For every NVIDIA, there can be a Palo Alto Networks which gaps down. So protect yourself, protect your gains, and protect your psychology and your capital. And before I wrap up, I just wanted to give an update on the website that I'm working on. Rain King Insights is coming soon. So I wanted you to be aware of that. And I've put down an email here. Please email support@rainkinginsights.com and let me know that you're interested, and I'll put you on a mailing list as we get closer to showing the offering. I'll share some more things about the offering in future videos as we get closer. But the domain that I was able to get is Rain King Insights. I couldn't get Rain King, that was taken. So I'm going with Rain King Insights. I'm excited about it. It's a lot of work, organizing a lot of content I think you'll appreciate. And also creating a website has been a learning experience as well. So hopefully, if you're interested at all, send me an email there and we'll get you on our list. So that's the general market update for Friday, March 8th. Have a great weekend, everybody, and I look forward to talking to you again next Friday.